This is revised proposed rule 702, cost corrective action and risk-based capital measures. Staff presenting Larry Fazio, Director, Office of Examination and Insurance; Steve Farrar, Loss Risk Analysis Officer; Lara Rodriguez, Deputy General Counsel; and Justin Anderson, Senior Staff Attorney, Office of General Counsel. Good morning.
Morning.
Take it away, Larry.
Thank you. Morning, Chairman Metz, Vice Chairman Metzger, and Board Member Rick Waters. We are here to present a second proposed rule to modernize NCUA prompt corrective action system by revising the risk-based net worth requirement. The second proposal is the culmination of the extensive work we have done since the January 2014 proposal to conduct additional research, including analyzing the over 2,000 comment letters we received, as well as input from the listening sessions held across the country during the summer in consultation with industry practitioners. I'd like to start with thanking everyone who contributed to this process, in particular the practitioners we worked with. Their willingness to explore with us alternatives of achieving the desired outcomes, along with their knowledge of the workings of credit unions, was very useful. Further, I would like to thank the numerous agency staff members that worked together to make it possible to present this proposal today. As you know, capital standards, in particular ones better calibrated to risk, are vital to the safety and soundness of financial institutions. Capital is the buffer that depository institutions, including credit unions, use to prevent institutional failure or dramatic deleveraging during a crisis. Financial crises are very costly, both to the economy in general and to individual depository institutions. For the financial system as a whole, research has shown that higher levels of capital reduce the probability of a systemic crisis. By reducing the probability of a financial crisis and insulating individual institutions from failure, strong capital levels confer very large benefits to the overall economy. While higher levels of capital can insulate depository institutions from adverse shocks, holding higher levels of capital does have costs, both to individual institutions and the economy as a whole. For the most part, the largest cost associated with holding higher levels of capital in the long term is foregone opportunities. That is, the loss of potential earnings from making loans, and the cost to customers and trading members of higher loan rates and lower deposit rates, and the downstream costs to consumers on this. Estimating the size of these effects is difficult. However, despite limitations on the ability to estimate these effects, the annual costs appear to be several orders of magnitude smaller than the losses avoided by reducing the probability of a financial crisis. Thus, it is clear that the relatively large potential long-term benefits of holding higher levels of capital outweigh the smaller long-term costs. As you know, credit unions experienced elevated losses and the need for government intervention during the recent economic downturn. From 2008 through 2012, 27 credit unions with assets greater than $50 million failed at a cost of $728 million to the Share Insurance Fund, due in large part to holding inadequate levels of capital relative to the levels of risk associated with their assets and operations. Furthermore, NCUA's ability to take enforcement actions to address supervisory concerns in a timely manner was cited by GAO as limited under NCUA's current corrective action regulations. As a result, over a dozen very large consumer credit unions and numerous smaller ones were in danger of failing and required extensive NCUA intervention and financial assistance or both, along with increased levels of loss reserving for the Share Insurance. A capital shortfall reduces a credit union's ability to serve its members. At the same time, the shortfall can cascade to the rest of the credit union system through the Share Insurance Fund, affecting an even broader number of credit unions. Because credit unions are important sources of credit for consumers, a capital shortfall that affects the credit union system could reduce general consumer access to credit for millions of credit union members. In a risk-based capital system, institutions that are holding assets that have historically shown higher levels of risk are generally required to hold more capital against those assets. At the same time, an institution's leverage ratio, which does not account for the riskiness of assets, provides a prudent floor against unaccounted for risk. A system including well-designed and well-calibrated risk-based capital standards is generally more efficient from the point of view of the overall economy as well as for individual institutions. A risk-based capital ratio is also more prospective in that as the credit union makes asset allocation choices, it drives capital requirements before losses occur and capital levels decline. In general, risk-based capital standards increase capital requirements at those institutions who have asset portfolios, on average, with higher risk. In that way, risk-based capital standards generate the benefits of helping to insulate the economy from financial crises, while also preventing some of the potential costs that would occur from holding unnecessarily high levels of capital at low-risk institutions. This approach provides positive net benefits to the credit system and the economy. Improved resilience enhances credit union's ability to function during periods of financial stress and reduces risk to the shared insurance fund. Since the 1998 legislation that enacted prompt corrective action standards for credit unions was implemented in 2000, there has been no meaningful update to credit unions' capital standards. The original proposal in January of 2014 was intended to rectify this and more closely conform NCUA's risk-based capital requirement to international and U.S. banking agency risk-based capital standards. It is necessary to modernize NCUA's approach to risk-based capital standards because the current ones are ineffective. Only 2 credit unions are currently governed by the existing standards. Since 2000, there have been 2 updates to international standards, and other banking agencies updated their risk-based capital standards in 2013. We have also learned various lessons during the recent financial crisis that need to be incorporated into NCUA's capital standards. In addition, as recently as 2012, the GAO and NCUA's Office of Inspector General have made recommendations for NCUA to update and modernize credit union capital standards. Based on input we received on the original proposal of January 2014 and additional staff analysis, we have concluded various changes to the original proposal are warranted to better optimize its calibration. The key decision in particular is to separate out interest rate risk in favor of an approach that incorporates measures of interest rate risk based comprehensively on assets and liabilities, including any derivatives or other risk mitigation strategies. An alternative approach to taking account of interest rate risk, as required by the Act, will be the subject of continuing agency research and analysis. With this proposal, NCUA would be specifically requesting advance comment on alternative approaches to taking account of interest rate risk. With removal of consideration of interest rate risk in this proposal, risk weights for this proposal predominantly account for credit and credit concentration risk. This necessitated significant changes to the risk categories and weights for investments in particular. It thus triggered the need for a second proposal, which we're here today to present. In addition to removal of consideration of interest rate risk in this proposal, the proposal also includes the following significant changes. The proposal would continue to amend the agency's current risk-based net worth requirement by replacing the risk-based net worth ratio with a new risk-based capital ratio for federally insured natural person credit unions. The new risk-based capital ratio predominantly, again, addresses credit and credit concentration risk and aligns more closely with how it is calculated by the other banking agencies. This proposal would continue to incorporate a broadened definition of capital to be used as the numerator in calculating the proposed new risk-based capital ratio. This broadened definition of capital provides a more comparable measure of capital across financial institutions and better accounts for related items of the balance sheet that are available to cover losses and protect the shareholder. On average, this broader definition would increase or benefit a credit union's risk-based capital ratio by over 50 basis points. This proposal would also remove the cap on the allowance for loan and lease losses account that is allowed to be included in the numerator. That the cap, as you know, in the original proposal was 1.25% of risk assets, and this proposal would remove that cap. The proposal would also amend the definition of complex credit unit by increasing the asset threshold from $50 to $100 million. $50 million to $100 million. Credit unions meeting this threshold have a portfolio of assets and liabilities that are complex based on the nature of their risk and the expertise and operational demands necessary to manage and administer such activities effectively. The 100 million asset threshold is a good proxy for complex, since it is a clear demarcation above which all credit unions engage in complex activities, and where almost all such cranes are involved in multiple complex activities. An asset threshold is clear, logical, and easy to administer when compared to the more complicated formula cranes are required to follow under the current rule to determine if they are complex. The $100 million asset size threshold would exempt almost 80% of cranes from any regulatory burden associated with complying with this rule, while covering nearly 90% of all assets in the credit union system. The threshold would also be consistent with the fact that the majority of losses, as measured as a proportion of the total dollar cost of the insurance fund, that resulted from cranes failing with assets greater than $100 million. It would provide regulatory relief for smaller institutions and would eliminate the complexity and potential unintended consequences of having a checklist of activities that would determine whether or not a credit union is subject to the risk-based requirement. I would also note that the proposal specifically requests comments from stakeholders on this particular provision. Like the original proposal, this proposal applies a higher threshold for well-capitalized than for adequately capitalized. However, the proposal would lower the risk-based capital ratio level required for a complex crane to be classified as well-capitalized from 10.5% in the original proposal to 10%. This graduated PCA category structure is within NCUA's legal authority to implement. But also note capital ratio thresholds are largely a function of risk weights. As this proposal more closely aligns within NCUA's risk weights with those of the other banking agencies, it follows that the risk-based capital thresholds should be aligned as closely as possible as well. The proposed 10% risk-based capital ratio level for well-capitalized credit unions, along with the 8% capital ratio for adequate, would be consistent with the total risk-based capital ratio requirements contained in the other banking agencies' rules. We'll discuss this approach in a little bit more detail later in this presentation. Concentration risk is a material risk and has been included in the capital standards for credit unions since 2000. GAO and NCUA's Office of Inspector General specifically made recommendations regarding the need for NCUA's capital standards to address concentration risk. Thus, this proposal continues to incorporate concentration risk in the risk rate framework. However, this proposal simplifies the concentration risk thresholds, reducing them from 2 to 1 from the original proposal. This would better calibrate this proposal to only address outliers, those typically more than 2 standard deviations from the mean. These concentration provisions apply to residential real estate and commercial loans and result in risk weights for high concentrations that are similar to or lower than current risk weights in the current rule. Therefore, this proposal would not force any credit unions to change their business model. Another key change between this proposal and the original involves differentiating between commercial purpose loans and the definition of a member business loan for purposes of complying with the statutory cap. This proposal does not change the fact that cranes still must comply with the statutory limitation on net member business. However, using a more relevant definition of commercial loans for purposes of risk weighting in this proposal allows for better reflection of the risk and improved data collection. It also allows NCUA to make the following sensible adjustments to how we define commercial loans for purposes of risk weighting. First, it allows us to exclude 1 to 4 family non-owner occupied residential real estate loans from the definition of commercial loans and risk weight them as residential real estate loans as the other banking agencies do. Those loans are specifically defined as member business loans for purposes of the statutory cap, but for purposes of risk weighting, they would be risk weighted as residential real estate. Second, it'll exclude any loans from the definition of commercial loans that are secured by a vehicle generally manufactured for personal use, except those that will be used in fare paying purposes or as part of a fleet. Third, it assigns to the portion of a commercial loan that is partially insured by the government a lower risk weight of 20%, and it does not count such loans toward the concentration threshold of 50% of assets for commercial. Fourth, it assigns to any amount of a contractual compensating balance associated with a commercial loan and on deposit in the credit union a lower risk weight of 20% and does not count those amounts towards the cap of the concentration threshold of 50%. And then finally, fifth, it does though include all commercial purpose loans regardless of the dollar amount. As you know, in terms of the statutory cap for member business loans, once a loan amortizes below $50,000, it doesn't have to be counted against the cap any longer. So this revised definition of commercial loan would better capture loans made for commercial purposes that have similar risk characteristics. Unlike the original proposal, this proposal differentiates between secured and unsecured consumer loans, as recommended by some commenters, given the difference in risk profiles. Secured consumer loans would continue to receive a 75% risk weight, as they did in the original proposal. However, unsecured loans would be risk weighted at 100%, which would match how all consumer loans are risk weighted by the other banking agencies. With this proposal, we did make another refinement as well to consumer loans. We separated out fully shared secured loans and assigned them a lower risk weight of 20%. For all loans, including consumer loans, real estate loans, and commercial loans, the proposal would change the definition of a current loan, that is a loan that's not delinquent, to increase it from less than 60 days past due in the original proposal to less than 90 days past due. This would align the definition of current loan with the other banking agency proposal. This proposal does eliminate the individual minimum capital requirement, or IMCR, as it has come to be known, that was included in the original proposal. The IMCR provision is unnecessary due to NCUA's statutory authority to reclassify an insured credit union into a lower net worth category, existing enforcement authority for unsafe and unsound conditions or practices, which is noted specifically in the rule in 702.1D, and the new capital adequacy provision proposed in new section 702.101. I would note that the other banking agencies' capital standards in this proposal are calibrated to be the minimum capital requirements for supervised institutions and address primarily only credit risk. Capital, again, helps to ensure that individual credits can continue to serve as intermediaries during times of stress, thereby promoting the safety and soundness of the system and the overall economy, benefiting the overall economy. As a prudential matter, NCUA has a long-standing policy that all federally insured credits should hold capital commensurate with their level and nature of the risks to which they're exposed. In some cases, this may entail holding capital above the regulatory minimum requirements, depending on the nature of the credit's activities and risk profile. Therefore, this proposal codifies this long-standing policy by requiring complex credit unions to maintain capital commensurate with the level and nature of all risks to which they are exposed, and to develop a written strategy for assessing their capital adequacy and maintaining appropriate levels. This proposed new provision is based on a similar provision in the other banking agencies' rules. It would not, however, affect a complex credit union's PCH classification. It rather, though, would support NCUA's assessment of a complex credit union's capital adequacy in the supervisory process and in assigning CAMEL and risk ratings. Following the publication of any final rule enacted by the board, NCUA would develop and publish supervisory guidance for examiners and credit unions on the application of this provision. We also note that the proposal would more than double the implementation time frame for credit unions and for us, honestly, by extending it to January 1st of 2019. This would provide credit unions and NCUA ample time to adjust to the changes and line up with full implementation of the other banking agencies' related capital rules. This longer implementation time frame will allow NCUA to make changes to the call report and have them in place hopefully a year before the effective date of the rule to give credit unions and our staff indication of what the risk-based capital ratio for complex credit would be before the rule becomes effective in January 2019. I would also note that this rule provides a longer phase-out period for certain forms of goodwill and intangible assets that were associated with an NCUA assisted supervisory merger. And that longer time frame would be through January of 2025. There are various other changes from the original proposal that are included in this proposal. Some examples include clarifying how QSO loans and investments would be weighted if they're consolidated under accounting rules, reducing the risk weights on QSO and corporate capital, perpetual capital investments, expanding how derivatives are risk weighted and treated, and providing additional options for weighting investments to define those risk weights for credit unions that are willing to use the alternatives such as the gross up and look-through. Consistent with the Act, which requires NCUA's PCA requirement be comparable to the other banking agencies, NCUA largely relied on the risk weights assigned to the various asset classes under Basel and the other banking agencies' risk-based capital rules for this proposal. However, NCUA has tailored the risk weights in this proposal for certain assets that are unique to credit unions, where a demonstrable and compelling case exists to differentiate between bank and credit union performance, or where a provision of the Act required us to do so. Thus, this proposal provides for even greater comparability to the rules of the other. At this point, I will turn the presentation over to Steve to provide more detail on several of the provisions that are included in this proposal, including how the policy arguments for why we have graduated tier structure for the PCA threshold, definition of complex, and the background of supplemental capital.
There are several sound policy reasons for setting a higher risk-based capital ratio threshold for a well-capitalized category than for the adequately capitalized category. Under the current rules, the credit union's capital classification could rapidly decline from well-capitalized to undercapitalized if it fails to meet the required risk-based net worth ratio level. Credit unions classified as well-capitalized are generally considered financially sound, afforded greater latitude under some other regulatory provisions, and are not subject to any mandatory or discretionary supervisory action. In contrast, credit unions that fall into the undercapitalized category are generally considered financially weak and subject to various mandatory and discretionary supervisory actions intended to resolve a capital deficiency and limit risk-taking until capital levels are restored to prudent levels. The lack of graduated threshold in the current rules construct for the risk-based net worth requirement does not effectively provide for earlier reflection of the credit union's capital category. Under the current rule, a change in the credit union's risk profile, capital levels or both, that results in a decline in the risk-based capital ratio does not affect its capital category until it results in the credit union falling to the point where the situation requires mandatory supervisory actions and could include discretionary supervisory actions. A more effective policy is to adopt a higher threshold for the well-capitalized category than for the adequately capitalized category to provide a more gradual framework where a credit union does not necessarily drop directly from well-capitalized to undercapitalized. This policy objective is reflected in how Congress designed the graduated PCA categories. For a given risk asset, the amount of capital required to be held for that risk asset is calculated by multiplying the dollar amount of the risk asset times the risk weight times the desired capital level. Thus, the risk weights are interdependent with the thresholds for the regulatory capital categories. The risk weights in this proposal are based predominantly on those used by the other banking agencies. For NCUA's risk-based capital requirements to be comparable, it should also be equivalent in rigor to the other banking agencies' risk-based capital requirements. The rigor of a capital standard is the primary function of how much capital an institution is required to hold for a given type of asset. Thus, if NCUA chose any threshold below 10% for the minimum required level of regulatory capital, it would either result in systemically lower ability for credit unions to accumulate capital, or the risk weights would need to be adjusted commensurately to offset the effect of the lower threshold. Adjusting risk weights in this manner would create more difficulty in comparing asset types and risk weights across financial institutions, and no doubt lead to misunderstanding and controversy. Conversely, A single threshold for the well-capitalized and adequately capitalized categories could be maintained, but raised to 10% to maintain the rigor of the risk-based capital standard and avoid adjusting the risk weights. This approach would set a higher point at which credit unions would fall to undercapitalized and therefore be subject to mandatory and discretionary supervisory actions. This would not be optimal, as the supervisory consequences for credit unions with risk-based capital between 8 and 10% would be worse than institutions operating the other banks. Maintaining the rigor of the risk-based network requirement is also important for another key policy objective: ensuring the risk-based requirement is relevant and meaningful. A relevant and meaningful risk-based requirement will result in credit unions more consciously managing capital levels in relation to risk. The risk-based requirement should be the governing ratio, that is, require more capital than the net worth ratio for credit unions with extraordinarily high risk profile. If the highest threshold for the risk-based capital ratio were set as low as 8% for well-capitalized credit unions, as some commenters suggested, the risk-based requirement would be effective. A graduated or tiered system of capital category thresholds that distinguishes between the well-capitalized and adequately capitalized categories will incentivize credit unions to hold sound levels of capital without invoking supervisory action before it's necessary. A few additional comments on complex. Based on the nature of their risk and the expertise and operational demands necessary to manage and administer such activities effectively, the following assets and liabilities or products and services of credit unions were used as indicators of complexity in the development of the proposal. They are member business loans, participation loans, interest-only loans, indirect loans, real estate loans, non-federally guaranteed student loans, investments with maturities of greater than 5 years, where the investments were greater than 1% of total assets, non-agency mortgage-backed securities, non-mortgage related securities with embedded options, collateralized mortgage obligations, and real estate mortgage investment conduits, commercial mortgage-related securities, borrowings, repurchase transactions, derivatives, and internet banking. Based on a review of call report data as of June 30th, 2014, all credit unions with more than $50 million in assets were engaged in at least one of the above products and services, with 99% having more than one complex activity and 80% having 4 or more. On the other hand, less than 2/3 of credit unions below $100 million in assets were involved in even a single complex activity, and only 15% had 4 or more. Moreover, the credit unions with total assets less than $100 million are a small share, approximately 10% of the overall assets in the credit union system, which limits the exposure to insurance funds in these institutions. Thus, an asset threshold of $100 million is a good proxy for complex. It simplifies the rule, provides regulatory relief for smaller institutions, makes it easier for credit unions to plan for complying with the rule as they grow and expand, and eliminates the potential unintended consequences that could result from a checklist of activities that would trigger a credit union being subject to the rule. I would note that this proposal specifically requests comments on the approaches to the definition of complex. Some comments on supplemental capital. This proposal does not authorize other parts of supplemental capital other than what is already allowed for low-income credit unions for purposes of calculating the risk-based capital ratio. Such authority involves a host of other complicated and controversial issues that would need to be addressed through additional changes to NCUA's regulations, including providing consumer protection, amending the share insurance fund payout priorities, and imposing prudent limitations on the ability of non-low-income credit unions to offer and include supplemental capital. This proposal is focused on modernizing the foundation of NCUA's capital standards. However, in this proposal, NCUA is specifically requesting advance comments on how supplemental capital could be included in the future. The NCUSF deposit. Like with the original proposal, this proposal addresses concerns about the NCUA capitalization deposit being reflected on the share insurance fund's balance sheet, as equity to pay losses and as an asset on the insured credit union's books. This proposal continues to deduct the NCUA capitalization deposit from both the numerator and denominator of the risk-based capital ratio. The 1997 U.S. Treasury report on credit unions concluded that the NCF deposit was double counted because it being an asset on the credit union's balance sheet and equity in the NCF. The Treasury noted that in lieu of expensing the NCF deposit, holding additional capital is necessary to offset risk of loss from required credit union replenishment. Congress established a higher statutory net worth ratio for credit unions, in part to account for the double counting concern. Also, the NCF deposit is not available to a credit union to cover its own losses or in liquidation. Thus, this proposal deducts the deposit in the ratio calculation like other assets not available to cover losses, such as goodwill and intangible assets. The NCF deposit deduction needs to be addressed in the risk-based capital ratio, not just the net worth ratio, to correct for the double counting concern for those credit unions where the risk-based capital ratio is the binding requirement. The proposal does not require credit unions to expense the NCF deposit, and we do not believe the risk-based capital requirement will lead to a change in how this asset is accounted for under GAAP. This proposal would apply to credit unions with $100 million in assets or greater. As of December 31st, 2013, there were 1,455 credit unions, or 22% of all credit unions with assets of $100 million or greater. This proposal would therefore exempt almost 80% of all credit unions to cover 90% of system assets. The board notes that the risk-based capital requirement in this proposal would apply only to credit unions with assets of $100 million or more, compared to the other banking agencies' rules that apply to banks of all sizes, for which there are about 1,975 banks with assets less than $100 million, which continue to be subject to risk-based capital calculation. Based on the December 2013 call report data, NCUA estimates over 98% of credit unions with over $100 million in assets already have sufficient capital to remain well capitalized under this proposal. We estimate this proposal would cause fewer than 20 credit unions with total assets of $10.9 billion to experience a decline in their capital classification from well capitalized to adequately capitalized. Specifically, only 27, or 1.86%, would have less than the 10% risk-based capital ratio requirement to be well capitalized. Of these, 8 have net worth ratios less than 7%, and therefore are already categorized as less than well capitalized. Further, 12 of the 27 operate with net worth ratios just above the required levels of 7 and between 7 and 8. NCUA estimates that these 27 credit unions would need to retain an additional $53.6 million in eligible capital in total to be well capitalized, assuming no adjustments are made to the asset distributions. Based on December 2013 data, NCUA estimates that if the risk-based capital requirement in the current proposal were applied today, the proposed risk weights would result in a ratio of total risk assets in the aggregate to total assets of 57.4%. Further, the aggregate average risk-based capital ratio would be 18.2%, with an average risk-based capital ratio of 19.3%. That would be compared against the 10% requirement. It's well above. A few more comments regarding concentration risk. Concentration risk is a material risk that NCUA addresses in this report. Using the December 2013 data report, all of those data here, this proposal were applied today, we estimate that the additional capital requirements for the concentration risk would apply to 149 complex credit unions in respect to first lien residential real estate loans. 67 complex credit unions would be subject to the concentration risk level for assigned to junior lien residential real estate loans. 2 credit unions would be subject to both of those concentration levels. 12 complex credit unions would be subject subject to the concentration level with respect to the commercial loan level of 50% of assets. Of the 12 credit unions operating with commercial loan concentration levels above the 50%, only 2 potentially experience a decline in PCA classification. The remaining 10 generally operate with fairly high net worth ratios. The concentration thresholds are more than 2 standard deviations from the mean for both the first and junior leagues. Roughly 90% of complex credit unions operate at levels below the concentration thresholds proposed for residential real estate loans, and over 99% operate below the commercial loan thresholds. Thus, most complex credit unions would continue to operate at a level in which the risk weights assigned would be the same or lower than the risk weights of the other banking unions. Just a few comments on the call report and additional data. The original proposal was intentionally designed to parallel the current approach by applying risk weights to assets using existing information contained in the call report, thereby minimizing transition costs and the associated reporting burdens. While the approach to assign risk weights in this proposal would require credit unions to report additional data on the call report, we believe that such an approach would result in a net benefit to credit unions in terms of improved precision of the capital requirement. Further, the more granular data will improve NCUA's off-site supervision capabilities. Unlike the original proposal, which is more closely tied to existing call report data, there are greater limitations in estimating the impact of the second proposal that we were able to do. Some of the key differences between the original proposal and the current proposal include, as Larry mentioned, the risk weighting of loans secured by non-owner occupied residential residential property at 50% rather than 100% as a commercial loan. Weighting insured and Federal Reserve deposits at 0%, and weighting all loans with government guarantees or portions of commercial loans with compensating balances on deposit at 20%. These differences, among others, would benefit credit unions as the lower risk rates would result in a lower capital requirement than those measured under the original proposal. Thus, NCUA estimates the impact of this proposal conservatively with the expectation that the benefit would likely that we had probably overstated the impact of it because of those adjustments. In addition, while there could be material variations to our estimate for an individual credit union, the areas where data is not perfectly matched are not likely to be material in the aggregate. Because several proposed risk components are not currently available from call report data, NCUA is providing credit unions with a risk-based capital estimator spreadsheet tool that can be downloaded from NCUA's website. Each credit union can privately and independently input their own financial data to determine what their risk-based capital ratio would be under this revision. Credit unions should refer to the instructions provided with this tool and the text of the proposed rule when using the tool.
Thank you, Steve. In conclusion, the goals of this proposal remain the same as the original: to be faithful to the Federal Credit Act in designing an effective and responsive risk-based requirement, support the mission of the agency in protecting credit unions and the share insurance fund, to better relate capital to risk, and to address outliers. It is not the intent to systematically increase capital levels across the system. Credit unions, by and large, are very well capitalized. This proposal is intended to help credit unions to take above average risk in serving members to be better able to absorb losses, leading to a safer, more resilient, and more stable credit union system. The agency wants to ensure that credit unions maintain sufficient capital to continue to function as financial intermediaries during times of stress without government intervention or assistance. I believe this proposal will have long-term lasting benefits. The proposed risk-based requirement may not be the binding requirement for many credit unions, but the high statutory net worth ratio limits our ability in this regard. However, the proposal would achieve the following significant improvements. Number one, it incorporates a modern approach to calculating the risk-based capital ratio on a comparable basis to other financial institutions and improves the definition of capital. Number two, it makes sure that the larger, more complex credit remain well capitalized as they grow and expand into activities with more risk. It will do a better job than the current rule in picking up today's outliers and tomorrow's, which by definition are relatively large and therefore can create material losses to the share insurance. Number 3, this proposal better calibrates the required capital levels for many types of assets, provides for a more sophisticated approach to investments and derivatives. It makes the risk-based system more relevant. Number 4, we take care of some anachronistic or otherwise troublesome parts of the current rule, like the regular reserve account and how dividend payments restrictions are to work. And then finally, it will lead to improvements in the call report and the data we collect, which should ultimately enhance our off-site supervision capabilities. I would not underestimate the potential for these improvements to have a lot of influence over time. Indeed, future generations may benefit more from these changes than the current one. With all that said, we therefore recommend the NCUA Board approve the proposed rule and publish it with a 90-day comment period. At this point, we'd be happy to answer any questions.
Thank you all very, very much. And a deep breath to the multitude of staff who have spent the past year poring over the comment letters and rewriting the proposed rule, networking, days, evenings, holidays, weekends, and really giving it their all to get to this point. So I deep gratitude to everyone who's involved in this. I also want to thank the 2056 commenters who took the time to read the proposal and send us a comment letter, because those comment letters were invaluable to us in reevaluating the first proposal and developing an alternative rule. And I think it's clear that we carefully read each letter and have responded to each comment. The vast majority of the changes we made were directly attributable to the comments that we received. So our appreciation to all of those comments. As I've articulated over the course of the past year, I believe there is a compelling need for this rule, in addition to our legal obligation for it. Throughout the past year, credit union officials have often asked me, since credit unions did not cause the financial crisis, why do we need a new rule on risk-based capital? And the short answer is that it's required by law. The Federal Credit Union Act requires NCUA to update risk-based capital standards to be, quote, comparable with the federal banking agencies. FDIC, OCC, and the Federal Reserve issued new risk-based capital rules in 2013, so in fact, we've already fallen a year behind, or more than a year behind now. In addition, both the Government Accountability Office and our own Inspector General found that the existing NCUA rule on risk-based network failed to prevent credit union losses as a result of the financial crisis. GAO concluded that NCUA should propose, quote, additional triggers for PCA that would require early and forceful regulatory action, unquote. The Inspector General noted NCUA needs a PCA framework that will identify increasing risk on a timely basis well before losses occur. However, even if we were not compelled to do so by law, by the GAO, or by the Inspector General, requiring complex credit unions to hold sufficient capital to offset their risk is simply good public policy. Simply put, addressing the problem of capital inadequacy of high-risk outliers protects the entire credit union system. Let's not forget, while credit unions did not cause the financial crisis, they were deeply affected by it. During the crisis, NCUA had to extend $26 billion in liquidity to prevent the credit union system from collapsing. Without an infusion of $20 billion from NCUA's central liquidity facility and an additional $6 billion from our line of credit to the U.S. Treasury, the credit union system, as we know it, would probably not have survived. As we know, natural person credit union losses resulted from the crisis reached $750 million, losses which had to be paid by all surviving credit unions. Many people assume that natural person credit unions failed during the crisis because they held less than 7% capital. That might seem like a logical conclusion, but it's not correct. To learn more about the institutions that failed, and so as not to skew the results based only on crisis failures, I recently asked the staff to review the failures of natural person credit unions from before the crisis, through the crisis, to after the crisis, and what they found was really eye-opening to me. In the last 10 years, 192 credit unions failed. Yet 24 months before they failed, their average net worth ratio was over 12%. A Officials in those credit unions likely believed they had more than enough capital to offset their risks. But clearly, holding net worth more than 500 basis points above the statutory 7% still wasn't enough. Today, credit unions hold average net worth of 10.9%. So for those who believe today's credit union system has too much capital because the average net worth ratio is 390 basis points over the statutory 7%, they're potentially in for a rude awakening. Don't get me wrong, I'm not saying each credit union needs to have net worth ratio over 12%. I am saying each credit union needs to have enough capital to offset its own risks. A well-designed risk-based capital rule would do exactly that. It should also be flexible and forward-looking. So credit unions can choose to concentrate in high-risk assets. That's fine. But their risk-based capital requirements should match those risks in order to prevent losses. And had the risk-based capital rule been in place before the crisis, we would have reduced losses to the share insurance fund, which surviving credit unions all had to pay. As we consider this proposed rule, it's important to note that this rule would require only 27 complex credit unions with high-risk portfolios to bolster their capital. In the future, as more credit unions attain complex status, this rule will prevent even more costly failures and save surviving credit unions from paying for their losses. As I mentioned, the agency has adopted many of the changes proposed in the comment letter. One issue we did not change, as Steve indicated, was supplemental capital. And we are specifically inviting comments on changes we could make in the future. As many stakeholders know, I have long supported legislation to authorize healthy credit unions to raise supplemental capital for the purposes of strengthening net worth. However, such authority raises complicated issues that would need to be addressed through changes to other NCUA rules, such as consumer protections and amending share insurance fund payout priorities. So to gain insight and the benefit of stakeholder experience, the preamble poses 6 questions about supplemental capital for commenters to consider and anything else they want to provide. I encourage commenters to offer suggestions about how NCUA could address those issues in subsequent rules. Another issue that was raised during the comment period for the previous proposed rule was NCUA's legal authority to promulgate this rule. Several commenters claimed that unlike the banking agencies, NCUA only has authority to decide a single risk-based requirement to be adequately capitalized without a higher tier to be well capitalized. This issue is so fundamental to the risk-based capital framework. I concluded that the agency should not move forward with a rule until we receive an independent legal opinion from an outside counsel analyzing our authority. So this past summer, while I was on vacation, I solicited 11 law firms around the country that specialize in financial services statutes and regulations. I solicited the independent legal opinion in order to support my own due diligence. I felt that we had to be absolutely certain that we had the legal authority before we moved forward. I ultimately chose the global banking and payment systems practice of Paul Hastings, based in Washington, D.C. Paul Hastings partners have years of experience on legal issues related to PCA from the perspective of financial institutions as well as from the perspective of a federal agency. In preparing the scope of work, I made it clear that I wanted their unbiased legal opinion on the issue, and that NCUA would not influence or predetermine the legal opinion in any way. If the opinion found that NCUA did not have legal authority to propose different risk-based thresholds to be well capitalized and adequately capitalized, then we would have redrafted the proposed rule accordingly. The firm researched every legal issue in the proposed rule for several months, during which outside counsel reviewed all 2,056 comment letters, plus any additional letters we received that questioned our legal authority. In November, a team from Paul Hastings presented an oral legal opinion to the NCUA Board. The oral legal opinion maintained that while certain parts of the Federal Credit Union Act are arguably ambiguous, it did support our proceeding with a two-tier risk-based capital framework comparable to the banking agencies, with one threshold to be adequately capitalized and the second to be well capitalized. During the oral briefing and in the weeks that followed, my board colleagues and I had opportunities to ask the outside counsel any questions we had about our legal authority. While some lawyers may present conflicting opinions about our legal authority, the fact that there are different statutory interpretations clearly demonstrates that reasonable minds may differ on this issue. Even if the law is determined that it is ambiguous, deference is given to the agency unless the regulation is, quote, arbitrary, capricious, or manifestly contrary to the statute, end quote. In our case, the proposed threshold of 8% to be adequately capitalized and 10% to be well capitalized are certainly not arbitrary, capricious, or manifestly contrary to the statute. In fact, we've clearly established that these thresholds are comparable to the banking agencies as required by the statute. So I'm very confident that we are moving forward on solid legal ground with the proposed rule. The cost of the Paul Hastings legal work included $100,000 for the oral opinion and the multiple consultations with board members, plus $50,000 for a written opinion. I should note that this is not a new budget request. It was paid in 2014 from our Office of General Counsel's line item for contracted legal services. My intent actually was to release the written opinion at this meeting. This week, however, the board received a letter from the law firm refusing to reverse their policy on confidentiality of written legal opinions. We have asked the firm to reconsider, and we hope to be in a position to release the written opinion in the near future. Finally, once again, I want to heartily thank the NCUA staff for their incredibly hard work to improve the rule of the past years and providing a reasonable timeline for the board to make informed decisions. But just to provide a sense of what occurred behind the scenes, staff logged every issue raised by the 2056 comment letters and prepared extensive summaries for the board. After the comment period, staff kept track of ideas raised at my listening sessions around the country. By November, staff presented each board member with 22 white papers on every major issue raised by the commenters. Each white paper described detailed pros and cons of various options to address commenters' concerns. Each board member was invited to ask questions and make recommendations on which options to pursue and why. Staff provided draft after draft and as many briefings as each board member requested. Then in December, while most people were enjoying the holiday spirit, the staff was drafting the preamble, all 400 pages of it, responding to board member concerns and achieving the target of getting the complete preamble and rule text to the board before the end of 2014. As Larry indicated, there will be a 90-day comment period which will begin when the proposed rule is published in the Federal Register. I think we have demonstrated that we consider every comment very carefully. So I urge stakeholders to once again provide us with their insights. To be as transparent as possible and to assist with understanding this complex rule, we have prepared a number of summary documents, which will be on our website as soon as this meeting ends. Right, John? These summary documents include comparison charts highlighting key provisions of the current proposal versus the January 2014 proposal, risk-based comparisons to FDIC's final rule, and answers to frequently asked questions. In addition, on Wednesday, January 21st at 2 p.m. Eastern Time, staff will be holding a webinar to explain the rules and answer questions. And because we are concerned that credit unions will need time to adjust to the new rule once it's finalized, we are planning an implementation period of more than 3 years. Again, this was in response to comments requesting ample time for credit unions to review their business plans and develop new policies consistent with the rule. In closing, I am confident this rule fulfills our statutory responsibility of exempting most credit unions, targeting only high-risk outliers, and most importantly, protecting the credit union system into the future. I do have a few questions. First, I would appreciate it if you could walk me through the costs of this proposal in more detail and why you think this rule will be beneficial and how likely it is to be worth the cost.
Sure. So obviously in developing this proposal, we looked at a variety of research. First of all, we referenced that in the preamble that's been done internationally in the U.S. on capital standards and the benefits and costs. We referenced much of that in the preamble. We considered that. We looked at costs in terms of crediting operations internally and did some work on that. And we complied with all requirements in terms of discussing that in the preamble and formal PRA estimates that are in there. So what I'll do at this point is just sort of walk through some of the explicit costs that are enumerated, both in the BAM, which deal with NCUA budget impact costs, as well as what's in the preamble in terms of the formal PRA estimate. I'll add a little bit of nuance there as I discuss it. So let me start first with the BAM. The Board Action Memorandum. In the budget impact section, what we did is estimated the cost it would take for us to reform and update all of our call reporting system related systems. So the call report itself would need some fairly extensive data field changes. We need to reorganize a fair amount of information. And also during that process, we want to take advantage of the opportunity to make it a little more simple for us to fill out as we go through that. So I know one of the concerns with this proposal is maybe the smaller, complex realm is how extensive will changes be to the call report. But our goal will be that if they're not really engaged in a lot of these activities, they won't even have to fill out those sections of the call report. Yeah, so if you're not doing derivatives, for example, you'll skip that section and so forth. So we'll have to make a lot of changes to capture all of those that any crediting could be doing, but the average complex crediting isn't going to get a lot of that necessarily. So we've estimated that the change to the call report itself, change to all the reports that come off of the call report, like the FPR, financial performance report, which actually shows the risk-based capital ratios, and some of our internal risk reports. We also have to change our exam platform called ARIES, and so the deck accepts the new data and also calculates this information correctly. So the variety of system changes that have to happen. We've estimated that cost based on historical costs of doing such changes. We've also estimated the cost to update policies and procedures. We have to update our national supervision policy manual, examiner's guides, and so forth. Camel letter to credit unions, examples of that. And then certainly, if the board finalizes this rule prior to it becoming effective in January 2019, we need to do extensive staff training. And that would probably most likely occur in 2018, closer to the rule's effective date, so we don't have any use of it problem. We train them too early and they don't use it. And so that's, we've estimated those costs. They would total of roughly $3.7 million over the 3-year implementation period. So a total of 3.7. And we've tried to approximate where they would occur in sequence through 2018. So that's the first cost to NCUA, which of course is indirectly paid for. In some cases, directly paid for by creditors. The second cost, and those are, let me just note, those are one-time costs. So we don't believe there would be recurring costs for the agency beyond those implementation costs. In terms of direct costs to credit unions, the estimate primarily revolves around, in the preamble in the PRA section, the one-time cost for credit unions to read the rule, make any necessary operational or policy and procedure adjustments. And I think we were fairly conservative in making those estimates, and that totals about $5.1 million in one-time costs for credit unions to read the rule, get familiar with it, make any changes they need to make. That's specifically addressed in the preamble. If at the point in time the board finalizes this rule, we would then also produce an OMB PRA submission request for changes to the call report, where we would estimate the cost for what it was for creditors to fill out the new call report based on the changes. But at this point, we've done some internal estimates, and I believe that would be less than $1 million per year in ongoing costs. And then, so those are the explicit costs dealt with both in the BAM and in the preamble. For the credit union staff labor to fill out the incremental cost for them to fill out the new fields of the call report. Another way to think about costs, and probably the most direct way in this proposal, the 27 credit unions that would have risk-based capital ratios below 10%, the requirement to be well, they would need to raise roughly $50 million in capital if that's the only way they fix it to make some other risk adjustments. So $50 million in capital they'd have to hold more of in order to be well capitalized to comply with the rule. lost opportunity cost on that, we roughly estimated at a gross level of about $2 million a year. So if you think about the cost in that sense, the average size complex credit union with this proposal would create to be subject to this proposal of $650 million. Our historical loss experience when the credit fails is about 20% of assets lost given the default rate. So that's roughly $130 million in cost. If one average size credit union fail, at the average cost per failure, that's roughly $100 million. That would pay for 4 decades worth of the costs. We also, as you alluded to in your remarks, back-tested this against failures that occurred over the last 10 years. And of the 9 credit unions that failed with $100 million or more in assets, 8 of those would have been picked up by this proposal and required that both more capital, therefore it reduced the whole system.
It looks like you do this a lot of times. And will those are available, aren't they? Those charts?
Many of much of that discussion is in the preamble, and they can also come to the webinar if you're not about it.
I know we both spent time talking about the new definition of complex. Could you please elaborate a little bit more on why you think $100 million in assets is a good proxy for a complex credit union, and what the benefits are of using $100 million instead of a whole bunch of qualifications?
Yeah, I'll answer that one. The Act has a requirement there, it specifically states we have to consider the portfolio of assets and liabilities in the definition of complex. So what we've done in there, we've gone through in that list that I gave you of what we consider to be complex activities and products, it's always going to be by nature controversial and constantly shifting. What is a complex activity today, 3 years from now, might be standard or not even done anything. So we have to deal with this kind of constantly shifting list, and what we define is if you had to fill out the checklist, if you check 3 or 4 of them, you said you're complex, that would be controversial from itself. The other thing that it would be a regulatory burden, and it would be controversial for what products we pick to be complex, because people would say, no, that's better than others are. It would be very difficult to continue to manage over a long-term time. The unintended consequences of that are something that we considered and came up when anytime the NCUA was setting that $50 million proposal that we have in place now, is the disincentive for a credit union to diversify its products and services, which would diversify its income stream. So we have all these unintended consequences. The credit unions would not do that service because now they're subject to complex. That isn't the desired outcome. The one real beauty of a nice simple dollar amount one is it's a wonderful proxy because it was kind of a clear demarcation at this level of all credit unions are involved in complex activities, and most are involved in multiple activities. And then as you look at the next kind of level down, there's a significant shifting in the amount that are involved in multiple complex activities. So you look for simple and elegant in the rule. You get the dollar amount credit unions can see it coming. They can plan for it simply versus making a decision on an activity that would make it complex or not. So that's what we think makes the $100 million proxy for assets and liabilities.
We proposed a rule on risk-based capital in January 2014. We thought it was a pretty good rule, and now we have pretty much turned it on its head. So just give me some comfort about why you feel that we got right this time, and that these are the right changes.
Well, it's definitely a better proposal, or we wouldn't have made the changes, I would hope. Here's how I like to think about that. We made some conscious guiding principle decisions with the original proposal in a couple of respects. We wanted to parallel the current rules approach to risk, and the current rule deals with as broad a range of risks than this proposal does, specifically individual risks. We also wanted to conform the original proposal more closely to call report data One, it allowed us to better analyze the impact, and two, it would require less ongoing burden for credit unions with the changes in the report data. And three, we wanted to try to reduce the reliance on the supervisory process to deal with risks that weren't being picked up by the proposal. Having said that, we got a lot of great feedback, and we listened carefully, and we made changes based on that feedback to this proposal. And I would note some of them, like separating out interest rate risk and dealing with some separately, were something we contemplated with the original proposal and talked ourselves out of. And I was actually glad to see that the commenters commented on that. I agree with those comments that it's better to have that dealt with separately, keep this ratio of credit risk focused, have a different metric that deals with interest rate risk, and do it more holistically. And so that was the biggest real change that we made when we made that shift to, okay, let's pull out a consideration of interest rate risk from the risk weight dimensions. That turned investments pretty much on its head. And so we went from a predominantly maturity structure approach to investments, which is a simpler approach. It's easy, you have pure categories based on maturity. When you go to credit risk, you're now having to separate by the type of issuer and the type of collateral. So that's why you'll see a lot more length to this rule. We had to add a lot of dimension to the investment definitions and categories of risk to go with all of that. So that was the biggest wholesale change. I would say that everything else from there, the changes were optimizing, calibrating, and some nuances. We did a lot of nuance changes that I think will benefit credit unions, individual credit unions, potentially significantly. Fully shared secured, good example of that. Contractual compensating balances on business loans. I think the moving away from the statutory NPL definition to commercial loans is a good change. We didn't approach that with the rule because we were a little bit concerned about the confusion it might create between the statutory cap and how we risk weight. But as we talked with commenters and talked with the practitioners, no, this is a sensible change. Let's make it. So we were able to make a lot of nuances and fine tuning to this proposal that we didn't attempt to do originally. So I feel good about that. We do need to continue to do some work on interest rate risk, as I had mentioned, and we will. We're soliciting comment on that in this proposal. And finally, I would just mention, in terms of why I feel good about this proposal, it does do a better job of picking up outliers than the current. I think we've struck a better balance between getting some more outliers than the current rule does, but not having false positives. And perhaps we don't capture as many as we might like to in this proposal, but I think we've made all of the adjustments we can really make that are sensible. And so I would note that this proposal, we would be more reliant on the supervisory process than we would have been on the original proposal. So that's another shift in the strategy, and that's something I've taken into account.
The supervisory process during the crisis, there were several large credit unions, which are no longer around today, which seemed to have sufficient capital because of their high leverage ratio, but we knew they didn't have sufficient capital relative to the risk on their books, and we couldn't do anything about it, which is why in the initial proposal we had the individual minimum capital requirement. So now that we've taken that out, which I support, created a lot of unnecessary angst, how are we going to deal with that issue?
So NCUA is able to address deficiencies in the credit capital levels relative to risk through three mechanisms. The first and foremost being the statutory authority Congress granted in with the NCUA Board's ability through other safety and soundness supervisory concerns to reclassify a credit into a lower net worth category. So if we had a credit with an eccentric risk or risk that wasn't specifically accounted for in this proposal, this capital ratio, or in the leverage ratio for that matter, the board could lower its PCA category by one, so it could drop a well to adequate or an adequate which would then trigger the next level down. Short of doing that, NCUA also has our broader range of traditional enforcement authorities for unprecedented conditions, levels of understanding agreements, using orders and so forth, and use those. And those are specifically actually noted noted in the current rule in PCA. And then also, I think a big benefit of this new proposal, one of the changes we adopted from the other banking agencies is the standard, explicit standard up front as we lead into the risk-based capital ratio calculation is despite the risk-based compliance risk-based capital ratio calculation, which is kind of like credit risk. Trading also, also needs to hold all capital measures, all its risk, go through its own analysis and document that. So adopting that standard, which is a long-standing supervisory standard, it's not new, it's something we've always had in place, but having it here in the reg to support the risk-based capital ratio, I think is important to do here. In fact, I'd like to quote from letter to credit unions 07C12, which is the CAMEL rating system, December 2007. The credit union is expected to maintain capital commensurate with the nature and extent of the risks of the institution. Regulatory capital requirements are minimum levels and separate and distinct from the credit's need to maintain capital commensurate with the level of risk inherent in operations. But also quote from the examiner's guide. Examiner's guide states, the adequacy of the credit's capital should correlate to the amount of risk it has taken or plans to take. The credit union board should have a plan for defining and maintaining an adequate net worth level. So that's just incorporating those things.
What would take away to these credit unions once we finalize this rule in terms of changing their behavior, the ones that are not immediately impacted by it?
So I would say, first of all, reiterate that most complex credit unions are not directly affected in the sense that they already maintain sufficient capital to comply with this rule. Having said that, the takeaway is, and the hope is, and one of the objectives is that there's a more conscious relationship of how they manage their capital in relation to their risk. And so it's more meaningful, it's more relevant, and it influences their discussions and the dialogues that they have with their management and their board more and their ultimate decision making. So that's, I think, a big takeaway. And that probably would be the single biggest improvement that could result from all of this.
And they don't have to wait until the rule is finalized, do they?
That's correct.
I have no further questions, but again, my heartfelt thanks to everyone who's involved. You did an amazing job of putting this a really fun product to.
Thank you. I'm going to read a statement which will probably take 15 or so minutes. So, I mean, if you're inclined to a morning nap, this is probably the time to do it. And I apologize, the statement may be a bit technical, but I'm a lawyer and I just can't help it. So, bear with me. The fundamental issue presented before the board today is whether NCUA has the legal authority to establish a separate risk-based net worth requirement for each of well-capitalized and adequately capitalized credit unions that are designated as complex. Section 216D of the Federal Credit Union Act addresses the risk-based net worth requirement for complex credit unions. Section 216D2 provides, quote, the board shall designate the risk-based net worth requirement to take account of any material risk against which the net worth ratio required for an insured credit union to be adequately capitalized may not provide adequate protection. A plain language reading of this section indicates that Congress did not authorize the board to adopt a two-tier risk-based net worth standard. If Congress had intended a two-tier system, the drafters would not have included the words to be adequately capitalized in the section. The inclusion of this phrase indicates that Congress intended to limit the risk-based net worth standard to a single-tier system, in any attempt by the board to read Section 216D2 as a baseline or minimum standard contradicts a plain reading of the text. If Congress had sought to design a two-tier system for credit unions, the drafters of the statute would not have undertaken to accomplish this goal by only referencing the adequately capitalized standard in 216D2. Instead, Congress would have included a reference to both the adequately capitalized and well-capitalized standards so as to reflect a two-tier system in a clear and transparent manner. The crafting of a two-tier standard would not have presented any technical or tricky drafting issues for Congress. By omitting a reference to well-capitalized standard in 216D2, Congress created an unambiguous single-tier risk-based net worth standard. Section 216C1, Cap A, Cap B provide an insured credit union is well capitalized if it has a net worth ratio of not less than 7% and it meets any applicable risk-based net worth requirement under Section 216D of the Federal Credit Union Act. An insured credit union is adequately capitalized if it has a net worth ratio of not less than 6% and it meets any applicable risk-based net worth requirement under Section 216D of the Federal Credit Union Act. That the net worth ratio or leverage ratio requirement differs for well-capitalized and adequately capitalized credit unions does not necessitate that the risk-based net worth requirement must also differ for well-capitalized and adequately capitalized credit unions. Instead, the statute merely provides that the risk-based net worth determination for well-capitalized and adequately capitalized credit unions must satisfy the requirement established under Section 216D. As noted above, a reasonable, plain language interpretation of 216D2 mandates that the board adopt a single-tier standard. Since the leverage ratio requirements for credit unions provided in Sections 216C1, Cap A1, and B1 exceed the leverage ratio requirement for banks, it is entirely rational and reasonable that Congress would have sought to offset the enhanced leverage ratio burden placed on credit unions by adopting a single-tier risk-based net worth system based upon the adequately capitalized standard. I appreciate that some may argue that NCUA's risk-based net worth rules should follow a two-tier system comparable to that of the FDIC. Section 216B1 Cap A of the Federal Credit Union Act provides that the board shall, by regulation, prescribe a system of prompt corrective action for insured credit unions that is, one, consistent with Section 216 of the Federal Credit Union Act and comparable with Section 26 with the rules adopted by the FDIC. Under basic principles of statutory construction, a general provision must give way to a specific. As such, the specific risk-based net worth rules tailored by Congress for credit unions in 216D of the Federal Credit Union Act must trump the general mandate that NCUA formulate its rules in a manner comparable to the rules adopted by the FDIC. The board may not seek to piggyback the FDIC's risk-based net worth rules by ignoring the statutory provisions specifically prescribed by Congress for credit unions. Interestingly, an NCUA white paper dated April 2007 concludes in part, quote, in relation to the risk-based net worth requirement, the statute precludes a distinction between well-capitalized and adequately capitalized, close quotes. The board also received testimony from a senior NCUA officer in June 2007 that, quote, the statute specifically limits the applicability of the risk-based requirement to adequately capitalized and the undercapitalized PCA categories, which does not allow us to put more emphasis on the risk-based requirement since we can't apply it to well-capitalized credit unions. So that also precludes us from mirroring how FDIC PCA systems work as well, close quotes. Apparently, over the last year, NCUA has taken a 180-degree pivot away from a single-tier interpretation of Section 216 of the Federal Credit Union Act in favor of a two-tier system, even though Congress has not acted to revise the statute. It is entirely possible that NCUA undertook to justify in a formal manner the legal basis for a two-tier risk-based net worth standard only after receiving numerous written comments challenging the legal underpinnings of the risk-based net worth regulations proposed by the board and published in the Federal Register on February 27, 2014. It is worth noting that a well-known law firm has rendered an opinion to the board regarding the legal authority of the board to establish a two-tier risk-based net worth system. Regrettably, and apparently not permitted to disclose the opinion letter itself or discuss, quote, the substance, analysis, or conclusions provided in the opinion letter, even though NCUA and as such the credit union community has committed to pay $150,000 today for the legal services rendered. If you are troubled by this misallocation of limited credit union resources and the complete absence of transparency, trust me, you are not alone. Let me pause there. I wrote this last night after receiving a letter from Paul Hastings saying I couldn't talk about this. It seems to me the chair has made some comments about the Paul Hastings letter, so let me pick up with the prior draft of the comments I was going to make on the Paul Hastings opinion as a lawyer who spent time in the Legal Opinions Committee over the last 30-plus years. It is worth noting that a well-known law firm has rendered an opinion to the board stating that a court could conclude that NCUA has the legal authority under the Chevron doctrine to establish a two-tier risk-based network standard. As a practicing attorney, I have served on the Legal Opinions Committee of large cross-border law firms and note that a could opinion represents a relatively modest standard of assurance. In the obscure, arcane, and highly technical and nuanced world of legal opinions, keywords such as could, would, should, and more likely than not truly matter. The recipient of a legal opinion prefers to know that a court will or should, or at a minimum, more likely than not, will uphold the legal actions of the recipient. An opinion letter merely noting that a court could uphold the actions of the recipient, although not entirely unhelpful, offers little comfort to the recipient. It is also worth considering that another well-known law firm, retained by CUNA, has questioned the legal authority of the board to propose a two-tier risk-based network regulatory system under the Chevron doctrine. The firm concluded, quote, NCUA's approach is contrary to the express language of Section 216D of the Federal Credit Union Act. Were NCUA so ill-advised as to adopt its final rule, the proposed dual-based capital standard approach that simply ignores the language of multiple parts of the statute structure that Congress actually adopted, that provision would be highly vulnerable to being overturned as unlawful by a reviewing court. Further, yet another well-known law firm retained by NAFCU has questioned the legal authority of the board to prescribe an individual minimum capital requirement, or IMCR protocol, under Section 216 of the Federal Credit Union Act. Although after receipt of the NAFCU Commission opinion letter, NCUA removed the IMCR provision for the proposed rules that are before the board today, any attempt by NCUA to backdoor an IMCR or substantially similar standard during the examination process may very well run the same risk of violating the Federal Credit Union Act as with a formal IMCR rule. Although not dispositive to itself, but indicating the intent of Congress, it should be noted that former Speaker of the House, Newt Gingrich, and former Senate Banking Committee Chair Alphonse D'Amato, both of whom held the positions in Congress when the credit union risk-based network rules were enacted, that have stated that it was not the intent of Congress to permit the board to issue two-tier risk-based network regulations. Speaker Gingrich stated in a letter to NCUA, quote, it was our intent to direct NCUA to apply risk-based requirements for a credit union's capital at the adequately capitalized level. If Congress wanted a different result, we would have indicated that. In fact, in other banking statutes, we did exactly that. Based upon my 30-plus years of experience as an attorney who has worked on many intricate issues of statutory and regulatory interpretation, I am of the view that NCUA does not possess the legal authority under the Federal Credit Union Act to adopt a two-tier regulatory standard. Section 216 of the Federal Credit Union Act, while perhaps inartfully drafted, does not appear fatally ambiguous on its face, and accordingly the Chevron doctrine should not apply, as a holistic, plain language reading of the statute in support of a single-tier risk-based network standard should prevail over any regulatory interpretation or wishful thinking to the contrary. While one may certainly argue that the board should have the authority to issue two-tier risk-based network regulations as a matter of prudent policy, These debates are best left to Congress as the source of the board's regulatory authority. If Congress acts, the board may follow, but without modification of the statute, the board lacks the legal authority to issue two-tier risk-based network rules and should not seek to invoke the Chevron doctrine so as to resolve in its favor a forced or strained ambiguity in the statute. Please note that I do not offer this analysis without some reservation or caveat. Reasonable minds may and will differ on this issue. I respect those who present well-reasoned principal arguments to the contrary, and note that, in my opinion, the better interpretation of Section 216 of the Federal Credit Union Act includes a two-tier risk-based network standard. Section 216D1 of the Federal Credit Union Act provides that the board may only adopt risk-based network rules for, quote, insured credit unions that are complex as defined by the board based upon the portfolios of assets and liabilities of credit unions. Instead of following the clear and unambiguous language of the statute, the proposed risk-based network regulations define complex by reference to a credit union's gross asset size as a proxy for the portfolios of assets and liabilities of the credit unions. Although such an approach is not wholly unreasonable, I would strongly prefer that the proposed regulations follow the express language of the statute and designate credit unions as complex only after an analysis of each credit union's portfolios of assets and liabilities as specifically required by the statute. I'm also dismayed that the board would consider adopting a rigorous set of risk-based network regulations without also providing members of the credit union community with the option of at least partially satisfying the requirements of the rule through the issuance of properly structured secondary capital. It is clear from Section 216.0 of the Federal Credit Union Act that, other than for low-income credit unions, a credit union's net worth may not include secondary capital for purposes of satisfying the leverage ratio of Section 216C of the Federal Credit Union Act. I'm not aware, however, of any similar limitation that applies to the determination of net worth for purposes of the risk-based net worth requirement, provided the secondary capital is structured in such a manner as to take account of any material risk as required by Section 216D2 of the Federal Credit Union Act, otherwise complies with applicable law and ensures the safety and soundness of the share insurance fund. Accordingly, I encourage the board to initiate a process that will lead to the promulgation of rules permitting properly structured secondary capital to qualify as net worth under the risk-based net worth regulations as ultimately enacted. I appreciate that such an undertaking is not without its unique challenges regarding an array of vexing issues, including without limitations. 1, the ability of secondary capital to absorb credit union losses. 2, the permanence of secondary capital. 3, member versus non-member secondary capital. 4, the availability of secondary capital for state versus federal chartered credit unions. 5, consumer protection for purchasers of and investors in secondary capital. 6, securities regulation of secondary capital issuances. 7, share insurance fund payout priorities and subordination of secondary capital. 8, capital contribution limitations of secondary capital as net worth for risk-based net worth purposes. And 9, contractual terms of the market demand for and the cost of secondary capital. These issues should not have a chilling effect on the willingness of the board to grant to the credit union community a workable methodology by which to raise properly structured secondary capital for purposes of partially satisfying risk-based net worth requirement. I recently read an article in CU Insight by Brian Grant, President and CEO of the World Council of Credit Unions, describing an array of secondary capital initiatives employed in the international credit union community. Instead of fretting and hand-wringing, NCUA, like its international counterparts, should take the leadership role in solving the secondary capital conundrum. Like long overdue modifications to the Build a Membership and Member Business lending rules, NCUA should actively endeavor to craft secondary capital regulations that will benefit the credit union community while maintaining the safety and soundness of the share insurance fund. It's beyond ironic that the board would seek to raise the capital requirements for credit unions without also affording the community a viable means by which to raise secondary capital. A thoughtful, prudently constructed secondary capital rule would afford the credit union community with a heightened opportunity to extend job-creating small business loans, thereby strengthening the economic viability of the Main Street business community. I am pleased that the proposed risk-based network rule no longer incorporates an interest rate risk component, although it is my understanding that the board will consider a separate and distinct interest rate risk rule. I encourage the board to seek input from the credit union community regarding any proposed rule by issuing an advance notice of proposed rulemaking. It is absolutely critical that the board receive timely comments from those who incorporate the interest rate risk rule into their business plans and econometric models. Such input will enhance the efficiency, effectiveness, and transparency of the regulatory drafting process and speed the implementation of the fully vetted interest rate risk rule. Since I am of the view that the board does not possess the legal authority under the Federal Credit Union Act to adopt a two-tier risk-based network standard, I will not support the risk-based network regulations as currently proposed. Further, it is problematic that I would support a single-tier risk-based network standard unless the rule permits the inclusion or at least acknowledges a good faith undertaking to investigate the viability of properly structured secondary capital in a calculation of risk-based network ratio to the fullest extent permitted by applicable law. It is also worth noting that in accordance with requirements of the Paperwork Reduction Act of 1995, NCUA staff estimates that the total non-recurring compliance cost of the proposed risk-based network regulations for both complex and non-complex credit unions approximate $5.1 million, and for NCUA totals $3.7 million. I anticipate some, if not many, credit unions may argue that these projections materially understate the actual cost of complying with the proposed risk-based network regulations. Regrettably, this additional burden falls on a financial services sector that is not too big to fail and was in no manner responsible for the recent financial crisis. NCUA has dedicated a significant portion of its institutional resources over the past 18 months to revising the proposed risk-based network regulations with the ultimate goal of ensuring the safety and soundness of the share insurance fund. While I certainly concur with this objective, I disagree with the approach. If NCUA had issued an advance notice of proposed rulemaking regarding the anticipated rewrite of the risk-based network regulations, there is little doubt that the overall vetting process and the proposed regulations would have progressed in a much more efficient, effective, and transparent manner. The allocation by NCUA of the cost savings generated from an expedited risk-based network rulemaking process to fighting fraudulent activity within the credit union community and assisting the management of credit unions with the development of vigorous and resilient internal control systems and procedures would have further advanced the safety and soundness of the share insurance fund without increasing NCUA's overall budget and placing any additional financial burden on the already overstressed credit union community and its members. Thank you.
Thank you, Chairman Matz. I want to thank staff again, especially the Office of General Counsel, Mike Canning, and staff, and Larry, for you and your staff for the very hard work on this. That is a year in county now in the process and still has a way to go. I also want to thank the credit union community for all of their thoughtful comments and discussions that we have had both in large groups and small groups since we released our first proposal a year ago. When people review this rule, they'll find that we have certainly taken, as you mentioned, Larry, their comments very seriously. It should be noticed that there are many substantive changes in this rule, and even though a strict construction of the Administrative Procedures Act would have allowed us not to respond to those comments in this document, because this is a new rule and not the original rule. We did read the comments and we're responding to them in this new iteration because it's the right thing to do and keeps that line of communication going. So we're following the spirit of the law and doing that even though this is technically a different rule. Second, I want to note that when I joined the board over a year ago, I inquired why our board meetings were not streamed live to the public, and I was informed that while we do post videos on our website after a meeting is over, there were technical challenges to live streaming, but that the agency was looking into that option. After last month's board meeting, I asked for a status report on streaming, indicating my strong preference to have it available in time for whatever meeting you considered the risk-based capital rule. Now, while staff has started testing live streaming, I regret it's not yet available. Staff believes it will be another couple of months before we have the equipment and technology to do live streaming efficiently, especially with the closed captioning that we are required by law to comply with our commitment to meet the needs of people with disabilities. And I want to thank the chairman for her commitment to improving our technology so we can soon do live streaming and by opening up our meetings today to video cameras in the meantime. And while I doubt that we'll win any Emmys for this, I think it is still a good service to the public. If there is a message from today's meeting, it's that we have listened and produced a proposed rule which I believe effectively balances safety and soundness with requirements that would be placed on certain credit unions. Now, the rule may not be perfect, and I would emphasize that it is, as many requested, a proposed rule, which everyone can comment on, and not a final rule. A rule this long is likely we can continue to make improvements, and that is why we invite further comment on it. But it's a good rule. It holds up well when viewed alongside our existing rule, the last proposed rule, or the considerably longer and more complicated RBC rules issued by other financial regulators. In fact, one thing that is very significant about putting out this proposed rule under the system, it allows all of you who've been commenting, and will see your fingerprints on all of this, it allows the public to once again comment. We're making our comments, but I want to hear what other folks have to do. If we were to vote against sending out a new proposed rule, that would actually leave us with the original rule, which we have already received the comments on, and we could move to a final rule without any additional input by the public, because that would have been concluded. I don't think that is the way to go, and what we don't intend to do today. We're going to put out a proposed rule because we think your opinions, not just ours, are important. And the only way we can solicit those opinions is to put this out for your comment, and at such time we will move to a final rule and we'll make the final change. As we invite comments on the proposed rule, I invite you to comment on whether we have gone actually too far, provided too much leniency, too much flexibility, and too long a transition period. It is possible the pendulum has swung too far and needs to swing back a little in the final rule. So I would appreciate if you give me your honest thoughts about that. I intend to support issuing this proposed rule for comment because I believe our current RBC rules are inadequate. And this proposed rule does a much better job of fulfilling our statutory responsibility to have a rule which is comparable to and equivalent in rigor to the rules of other banking regulatory agencies, even if it is not precisely identical, because it takes into account the unique characteristics of credit unions. Why I do feel we have achieved a fair balance is because the proposed rule exempts nearly 80% of credit unions, yet it covers 90% of the assets insured by the share insurance fund. So what we have is maximum coverage and minimal burden. To those who suggest that the burden of a credit union charter and the National Credit Union Share Insurance Fund insurance is too great, and they better be better off as banks, as I've read some write, I would remind them, in addition to changing their tax status, the risk-based capital rules for banks are more complex and burdensome and contain no, let me repeat, no exemption for small banks. Every bank, no matter how small, must comply with risk-based capital for banks. While under this proposed rule, nearly 80% of credit unions are exempt. Now, it's taken a full year to produce this new RBC rule, largely because we have listened to the more than 2,000 comments that we've received, to the hundreds of comments at our national listening sessions, and to the hundreds, if not thousands, of comments all of us on the board have received in meetings with state leagues and individual credit unions. So how have we listened? Well, let me list just a few ways. We started with a longer than normal 90-day comment period almost a year ago.
We're giving everyone a second formal opportunity for comment by issuing a new rule with a new 90-day comment. Now, we revised the definition of complex in a way that doubles the size of the exemption for small, non-complex credit unions from $50 million in assets to $100 million, and done so in a bright line way which does not add additional regulatory burden month in and month out for credit unions to try to figure out whether they have to comply. We have removed interest rate risk from this rule. As a result, we are no longer trying to measure IRR and credit risk with a single rule. And we've clarified that individual examiners cannot set risk-based capital levels by taking out the entire individual minimum capital requirement. We have more than doubled the length of the implementation period, even though the rule is simpler and will affect far fewer credit unions. And I will say that's, as I mentioned earlier, and whether we've gone too far, one of my biggest concerns for having a longer implementation period was because of our changes to the call report, which still exists, but also because we were considering interest rate risk. And with investment portfolios, it's like moving a battleship. I can understand what that means with more time. If we don't have interest rate risk in here, I will question whether this is too long a period of time. And I'd like to have your input. We've cut in half the number of concentration levels for both member business loans and mortgages. The remaining concentration limits will impact only a small number of true outliers, just as Larry mentioned. Those that are at least 2, and in some cases, as many as 5 standard deviations beyond credit union averages. We've allowed credit unions to count their entire allowance for loan and lease losses rather than capping it at 1.25% of assets, as in the first rule. We have increased by 50% the definition of what constitutes a current loan from 60 days to 90 days. And I think you should know this is a significant positive change for credit unions. It goes beyond this rule. It brings our definition of current in line with the other banking regulatory agencies. And I can tell you from my past experience and roles that this was an important issue. And embedded in this rule is a policy change that is going to have a dramatic impact on credit unions. We have reduced the risk weight for investments in QSOs by 40%, from 250% to 150%. And for loans to QSOs by 1/3, from 150 to 100%. In addition, a wholly owned QSO can consolidate itself under GAAP, resulting in no separate capital charge for the QSO. Risk weights are now more comparable to the risk weights in the bank RBC rule, and where there are differences, as there is for consumer loans, they are generally lower for credit unions because of their lower risk profile. And Larry, when you do your presentation later, I would recommend that everyone who has an opportunity, and please do to stay around for that, some of the pie chart breakouts make that very clear. 78% of covered credit union assets will have risk weights identical to their bank counterparts. 19% will have lower risk weights. Less than 2% will have a higher risk weight. And we've also added a 10-year phase-in for supervisory goodwill, an issue that we talked about extensively in some of the listening sessions. We listened, we understand, and we have solved that issue. Now, have we agreed to every single request? No. Because after careful analysis, some of them actually didn't make sense, and others actually conflicted with one another. But we made a good faith effort to enact an evidence-based rule. And where we disagreed, we explained why, which is why the preamble is this year's version of Gone with the Wind. But for those who complain it's too long, too complicated, I invite you to read the comparable rules for banks. There's an old adage: when the facts are not on your side, you argue the law. When the law is on your side, you argue the facts. And both the facts and the law are on your side, you argue the process. So while we are likely to hear comments down the road on each of these issues, I'd like to talk about some of those as we have put this rule together. First of all, I'd like to talk about the process that staff has gone through and working with you this last year in a little more detail. I would note that it's been very deliberate. As you know, the first proposed rule was issued a year ago. A final rule is unlikely to be issued until later this year and will not take effect until January, at this point, 2019, if this proposal goes as written, or for a full 5 years after the process began. The argument that we may not have enough time to review the rule certainly wouldn't hold weight. And it's still under consideration for almost another year now, so we still have even more time. So we're in the mid-process right now, and people have additional opportunities to comment and make suggestions for improvements and weigh in. whether it's on substantive changes or, as Mr. Rick Waters pointed out, on legal issues. There's a lot of other folks out there that I would love to hear from about these things as well. So this wasn't just dumped on us this week or even 2 weeks ago. It's been under active consideration for over a year. Staff has provided board members with multiple briefings on our existing rule, the first proposed rule, the second proposed rule, and individual components of each rule. Where we chose to do so, it's also been an iterative dialogue. We've had opportunities to brief staff on our thoughts on the issues before us and to ask questions when they've responded to. Staff prepared for us about 1,000 pages of white papers on more than 20 separate issues, from the allowance for loan loss, lease losses, to supplemental capital. And I know my office started receiving these white papers from Larry and his team in November. Each white paper had a dozen or more sections, including a summary discussion of options and a recommendation, a summary of possible changes that will be needed in call reports to implement the proposal, an analysis of the legal issues in NCUA's authority, an analysis of accounting issues, an analysis of applicable sections of the Federal Credit Union Act, and an analysis of how the issue is handled under the Basel Accords, an analysis of the FDIC's rule in the same area, a cost-benefit analysis of the PEARL's impact on the credit unions and the agency, an analysis of options, an analysis of comments received on the issue, an analysis of state supervisory agencies' concerns, additional background information including an analysis of the current NCUA rule, the proposed rule language, GAO recommendations, the NCUA IG recommendations, and analysis of material loss reviews. Now, these reviews were very helpful to me and my staff. In fact, I want to give kudos because for the past 2 months, my senior policy advisor, Mike Bradley, has provided several hundred detailed thoughts, comments, and questions in as transparent process as possible to the other 2 senior policy advisors and to appropriate agency staff. And I want to thank Steve Bozak also for sharing that as well. It's been very, very helpful. Staff has been fully responsive to all of our requests, and we've had adequate time to consider those. After we completed our review of the white papers in November and early December, we received the compilation of that work in the draft rule and preamble in December, late December, which we were able to review because we were first familiar with all the elements in it from the white papers and the work we had done on previous rule. Nonetheless, we still had an additional over 100 questions, concerns, and recommended improvements in the preamble, which we shared then with Larry Fazio of ENI, Larry Rodriguez of OGC, and several staff. And we resolved each of those issues to our mutual satisfaction. And I want to thank you for looking at that. I know it's very detailed work. I can say for my part that this process, my staff has been open, your staff has been open to have that ongoing dialogue. Second, I want to address this agency statutory to issue the proposed rule. And I would begin by noting that we have a statutory obligation as well as an authority to issue the new RBC rule. We'd not be doing our job as regulators if we did not issue an RBC rule that protects the safety and soundness of this National Credit Union Share Insurance Fund, as well as the roughly $1 trillion American consumers have on deposit with federally insured credit unions. We have a duty to protect against any material risk and to design a system which is comparable to the FDIC's RBC system. A number of people have attempted to take one clause out of the Credit Union Membership Act out of context or ignore other languages in the Act, and to misapply the court's rulings in Chevron and related cases to contend that the NCUA does not have the authority to issue separate capital requirements for well and adequately capitalized credit unions. I disagree. So does our Office of General Counsel. Both well and adequately capitalized credit unions are required to meet, quote, any applicable risk-based network requirement. Under the Chevron standard, that requirement can contain multiple parts, and under the Credit Union Membership Act, it must be comparable to the FDIC's RBC requirement. Now, our rule will not be comparable to the FDIC rule or parallel in substance if the FDIC has separate RBC levels for well and adequate, and we do not. I would further note that the FDIC rule also refers to a risk-based capital requirement in the singular, which has separate levels, though, for well and adequately capitalized banks. The reference in Section 2116D, Subpart 2 of the Credit Union Membership Act to designing, quote, the risk-based network requirement to take into account any material risk which to get the net worth ratio required for an insured credit union to be adequately capitalized may not provide adequate protection, provides a floor but not a ceiling on RBC. and does not preclude separate RBC levels for well and adequately capitalized credit unions. In fact, I would say if down the road there was ever a decision to have a single standard for risk-based capital, I would certainly not consider going to the lowest common denominator. It would be the higher number, not the lower number, to protect the share insurance fund. So common sense tells me that if a credit union voluntarily chooses to meet a higher well-capitalized RBC standards, it is less likely to fall below adequately capitalized. And I think that is pretty well easy to understand. The purpose of prompt corrective action in RBC is to reduce risk to the fund. That is what separate RBC levels do. This is neither arbitrary or capricious, and it is a reasonable and permissible interpretation of the statute allowed under the Chevron doctrine. Now, notwithstanding attempts to rewrite history by individuals who are now affiliated with entities that receive hundreds of thousands of dollars lobbying for credit unions, I believe both our authority and our obligation to act. Third and finally, I would like to address the cost. Larry, you mentioned the cost, and I think this is important because you sometimes speak in aggregate and people look at that. The cost to implement for credit unions of $5.1 million. You're looking at 6,000 credit unions. And the cost per credit union, I believe, is $1,260 is the average cost. That when you multiply that out, it makes about $5 million. I don't want anybody getting the impression that each credit union is going to cost them $5 million to read and implement the rule. But if you will notice in the rule and the preamble, those costs are articulated. And for non-complex credit unions to evaluate where they are, it was less than $700 individually. So I think that is important. In addition, only 19 out of more than 6,000 credit unions, or less than 1/3 of 1% of all credit unions, would have their PCA categories reduced as a result of the adoption of this rule. Now, those credit unions would either have to raise, in aggregate, about $50 million in additional capital over the next few years, which they would have another 3 or 4 years to do, or make compensating adjustments to reduce the risk of their balance sheets in order to remain well capitalized. All but one of them also would have the option, of course, allowing their PCA category to drop from well capitalized to adequately capitalized. In addition to the fact that this roughly $50 million impact on a $1 trillion plus system will be spread out over 3 or 4 years, the cost will be more than offset by a projected decline in losses to the share insurance fund. The agency back-tested capital requirements, as the chairman had asked, and Mr. Fazio went into more detail, and back-tested requirements for credit unions that failed during the Great Recession began in 2008. And while back-testing has limitations, a review of just 9 failed credit unions that met the definition of complex shows that these 9 institutions alone would have had to raise more capital to remain well capitalized. I think this is a good window into the future. Equally importantly, NCUA would have had an earlier warning of possible problems with these credit unions and might have taken supervisory actions to reduce or eliminate those losses. In short, it doesn't take a very large reduction in risk to have a very large benefit. While costs and benefits are always difficult to estimate, in this case, the costs are relatively low and the benefits to credit unions and their members are large. In conclusion, I want to simply note that the existing system is broke and does need to be fixed. Our current RBC rule requires only 2 credit unions to hold more capital than they are required to hold under the leverage ratio. 2. In addition, of the 27 credit unions that failed during the Great Recession, only 2 were considered less than well capitalized under the existing rule. Yet those 27 failed credit unions cumulatively cost the share insurance fund $728 million. Costs that were borne by other credit unions which took less risk and were better capitalized. It is for the remaining 6,000 plus well-run credit unions and their members that I think this rule to be put out for comment, and will support that. And again, just want to iterate one more time, we're not making it a final rule. We're asking, should we put out this document for people to comment on it? I think they deserve an opportunity to comment on it. I would be doing this.
Thank you. Clearly, reasonable people can disagree, but we can continue this forward. Unless at least 2 of us believe that we have legal authority, and I personally feel very confident that we do it, so that we have a very strong legal opinion supporting that in addition to the general motion?
I move the board approve proposed rule, part 702 of NCUA's rules and regulations for a 90-day comment period as attached to the board action.
All in favor, say aye. All opposed, nay.
No.